Hi, this is James at WEstpac with the nearly end of day report for Friday, July the 20th. It's just about 20 past 3 here in London. No US economic data to report today. We had the Canadian CPI come out a little bit higher, but still at 1.5% below the 2% target. The core rate actually bang on the 2% target. We had German producer prices decelerate further at 1.6% annual pace. That's the pace they were running at the depths of the global downturn in early 2009. Just another indicator that's consistent with the deteriorating economic environment that Germany finds itself in. The UK budget figures for June, budget deficit figures, were wider than expected, adding more to speculation that the government will miss its full year 2012-13 120 billion deficit target. The government's under a lot of pressure to ease back on austerity because the UK economy is struggling to work its way out of recession, and although the numbers are going to be distorted in the next few months by strange weather, shifting public holidays and the Olympics, the underlying growth story in the UK remains soft and indeed probably mildly recessed. The European finance ministers confirmed that Spain would receive up to 100 billion to recapitalise her banks. Initially 30 billion euros will come from the EFSF, which is still in existence because the ESM, the European Stability Mechanism, hasn't yet come into operation because of legal issues, because of European issues basically. It was also confirmed, though, that the Spanish government will have ultimate liability for the bank recapitalisation bailout funds. Now, this has really perturbed investors because just 3 weeks ago we heard EU leaders say that the banks would be recapitalised directly from the ESM and that it wouldn't involve an extra liability for the Spanish sovereign. Now it's been confirmed that EU leaders simply cannot deliver. Don't listen to what they say at the next summit. Just look at Ms. Merkel's face to see if you can work out the truth in terms of what the next step in this sorry saga is going to be. So the other thing is that Spain has come up with something like 15 billion euros to bail out its provinces. Catalonia and Valencia in particular have lost access to financial markets, but the Spanish government has said that that 15 billion won't be an extra debt issuance. They've found it somewhere. We think maybe from cash reserves, but the point is, investors are not liking it. They're not liking that Spain has suddenly got this money, that this 15 billion. They don't like the way the numbers add up, and they certainly don't like that the fact that EU leaders simply cannot deliver on what they commit to. For that reason, Spanish 10-year bond yields are at 7.2% at the moment. The Spanish stock market is down 5% today. And there are other negative factors too. We had some disappointing news from Vodafone, Nokia. The Chinese have said they're not going to ease back on their clamp down on property prices. So other factors that have weighed against markets, but it's the Spanish situation and the growing realisation that the European sovereign debt crisis is in full swing still, and is not abating. It's that factor that's really upsetting markets. So to give you some numbers, the FTSE in London down 1% today, the French market's down 2%, the German market down 1.6%, the Spanish market down almost 5%, as I said, and the Italian market's down 4.3% at the moment. Now remember, still an hour to go or so of trading in Europe, and of course anything could happen on Friday after the European close in the US market, but they're the numbers as they stand at the moment. In commodity markets, oil is down 1.8% at $91 a barrel. Gold is down 0.3% at $1,576 an ounce, and copper prices down 2.6% today. So the risk-off attitude in equity markets has fed through into commodities, and indeed the Aussie dollar as well. It's at 1.038 against the US dollar. It was 1.04 this time yesterday. Okay, that's the end of this week. We've got a big week coming up next week with the inflation numbers in Australia, the Reserve Bank of New Zealand's latest pronouncement, and US GDP numbers on Friday. We think they'll show a weak 1.2% annualised growth pace for the second quarter, but the report will also include back revisions based on more accurate source data that could reveal that the profile of the US economic recovery up until now has actually been weaker than officially published. You may recall that a year ago in July, pretty much precipitating the big collapse in markets in August last year, we had a similar thing happen where the Commerce Department revealed that the models that they were using to estimate growth based on previous recovery cycles just didn't fit with this cycle. And the risk is we're going to see, and as they got more accurate data from tax records and so on, it revealed a much slower growth pace. And our sense is we're going to see something similar next week. That could be the event that helps boost speculation about another round of quantitative easing from the Federal Reserve. So plenty to look forward to for next week, but for this week, see you soon.